Welcome to today's webinar, compiled and produced by the team at BizNews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the BizNews.com channel on YouTube. Well, that is a little optimistic, later today, but who knows? Perhaps through the magic of technology, we will get the recording up a little later, but this is a new starting time for us, 5 o'clock in the afternoon here in South Africa. Reason for that, Martin Freeman, who joins us now from New York. Martin, and good to see you. And of course, Justin Clarke, who is OrbVest director here in South Africa, is in a far, well, warmer spot now in Durban than Martin. Good to see you. Well, Martin, I'm just looking at the screen, and it talks about one Grand Central, which I know, Grand Central Railway Station, 42nd Street. Now, I remember 42nd Street wasn't that a song by Billy Joel?
I'm not going to comment on that, but I can just tell you that it's at the moment a very busy street again, what with all the tourists arriving and certainly making their way to Times Square, and it's good to have Broadway back. So the US is in a good place at the moment right now, and it's good to be busy in New York again.
Well, we're not very happy here in our part of the world, are we, Justin, about the US right now by closing off the flights because we we identified this Omicron, which is everywhere in the world.
It's miserable, Alec. I'm sure that there are a lot of listeners online that were planning either to have their kids come and visit them, or alternatively they were going to go overseas. It's just caused a complete mayhem here.
It really has, and I suppose if the roles were reversed, there'd be all kinds of squeals coming out of the other country. But when you're only 0.5% of global GDP, you are a price taker. And it's also affected our currency a lot. And I actually got that a bit earlier in the BizNews portfolio webinar. A few people were asking me whether it still makes sense at 16 to the dollar to be taking money offshore. My answer was, I'd love to hear your answer to this one, Martin, but I'll share mine with you in a moment.
Well, the first thing I just want to mention is regarding the US at the moment. It feels like I'm back in South Africa every day, because every single time I turn on the TV, the only thing I ever hear about in the headlines is South Africa. It's literally the only thing on the news at the moment. But in terms of the US, I think obviously they're just taking the cautious approach. I think what's important is that when Pfizer and Moderna announce in the next couple of days the vaccine efficacy and ability to combat it, I think they will review a number of the travel restrictions. I myself had my entire family coming over, and that's now been obviously suspended. So it's very frustrating for me also. I think, Alec, regarding the dollar-rand exchange rate, we've said for years, just invest consistently into building over time, and you will average out. And if it goes back to 14 or 13, you'll still average out at a good rate. And if it stays where it is or gets worse, well, then you're still going to be earning dollars. And so that's really what offshore investing is all about. I think also the moment you get past that first year of earning dividends, it ultimately means thereafterwards, whatever the original rate is pretty irrelevant, because you're now in the dollar world and you've caught up the differential.
I had a conversation about this as well with Magnus Haystack every Wednesday, and you recall Magnus from our webinar, from our conference. In fact, let's put that picture up there, because it's not often you get two handsome guys in one conference together. You're right. But Magnus was saying today that one of the biggest risks for South Africa, they've identified at Brenthurst 4 big risks, and one of the biggest ones is the currency. And he actually is now talking about it being the biggest risk. And there's a bit of seeping coming into the conversation here. There was an article by Michael Sachs, the former executive at the Treasury, who left there because things weren't really being handled that well. And he flagged that as a big risk. We've also seen similar by some of the journalists, some of the good journalists here in South Africa, Claire Bisseke as an example, saying that a similar story along those lines. And Magnus is now waving the flag there. And when he starts talking, he says, you'll wake up one day and your rand's heading towards 20, 25, 30, and then it's far too late to make the kind of precautions that you have. So I think it's pretty sensible what you've just shared a moment ago. But Justin, from your side, clearly you talk to South Africans all the time. Does this become part of the conversation with the rand recently having fallen from 13.80 to over 16 to the dollar?
Yes, I think first of all, there are a lot of investors that do already have some funds offshore. So not all of our South Africans are moving money from South Africa. And the bigger problem, Alec, of course, is exchange control. You have your discretionary R1 million, and a lot of people leave it till the last minute, which is why we always have this crazy rush at the end of the year. I must say, I think that we'll probably end the year with two very, very big months in November and December, purely because of that, because people leave it till the last minute. And if I can just talk to the exchange rate, I think the perfect example is my family immigrated to New Zealand years ago, and I remember them paying a huge premium at that point to get their money offshore. And it was 3 rand to the New Zealand dollar. They moved back here, and it's 10 rand to the New Zealand dollar after living there for 10 years or so. So ultimately you've got to look at the probability of the rand devaluing over time, and you've got to bet against that. And I think, as Martin says, if you just pick at it and keep moving a little bit by little bit, don't look too much at the exchange rate, then ultimately your weighted average of what you bought those dollars at will even out.
Dollar cost averaging, as we term it, I suppose, in the financial community. I'm sure we're going to get questions about that. Before we carry on with our conversation, perhaps those the BizNews community members who are attending this webinar can just make sure 2 things. One, you can hear us. There's a little high five or a little hand on your control panel. Please hit that if you would, so that I can see that we're coming through to you loud and clear. Thank you very much. I see the high fives, the hands being raised there. And secondly, this is interactive. This is the opportunity you get to ask questions, the questions you want asked. I'll make sure that we retain your anonymity by not using your surname. So if your name is Joe Soap, I won't call you Mr. Soap, but I'll call you Joe. So that's the story. So you have no fear whatsoever of being pinged for having a stupid question. Remember, there's never ever stupid questions anyway, only stupid answers, and you won't get any of those today. Martin, it was so good to have you.
Yeah, you mentioned it's an interactive webinar, and you do so much for everyone in South Africa. I would like to reverse that and say that to all your listeners today, I had the pleasure of attending this BizNews conference, and I have to say that it was absolutely amazing. For anyone wanting to meet great people, just gain fantastic insights, it's really something special. And so I know that you always have limited capacity. I might not be at the next one, but for anyone who can attend, I'd strongly recommend it.
Thanks, Martin. And that's a nice picture there of the 2 of us having a nice moment, a quiet moment. Was that you taking the picture, Justin?
No, it wasn't. I'm not that good a photographer, I'm afraid.
But lovely, a lovely picture.
Like that, Alec.
But it really, the conference is extraordinary, and we've got a amazing lineup again in the March conference, which is from the 1st, 2nd, 3rd, 4th of March. We've even got somebody who's going to be riding a bicycle. Get this, Justin, riding a bicycle from Cape Town to the Drakensberg. But it'll be solar powered. I can't give you any more information, but we're very excited at BizNews. He approached us. He said he wants to come to the conference, but he's a student, and how does he do it? And he came up with this idea, and well, we're looking forward to. His name's Andrew, so we're looking forward to having Andrew there. Helen Ziller will be our keynote speaker. Magda Wizikcha will be there to talk about lots of things, including her fight against state capture. Tsepo Malelwe, who's the new chairman or owner of SAA, South African Airways, and also of Harris, and also of Arena Publishing. an incredible human being who I know very well. He's been to one of the conferences. He'll be talking. Dirk van der Walt, the founder of We Buy Cars, is going to be with us. Nelson Mandela's 5-year-long personal bodyguard. There'll be some stories. He'll be with us. So I don't want to, leave people out if I take it off the top of my head. But we have got a cast of. Oh, I must just tell you, Peter van Ketz is going to be there. Peter has actually, if he wants to come and see you in New York, no problem for him. He's rowed across the Atlantic, rowed in a rowing boat twice. And he's walked to the South Pole representing South Africa, where we came third behind the Norwegians and the Brits. So in the big centenary celebration of Amundsen and Scott being the first people to get to the South Pole. So we've really got a cast, and Justin, of course, will be there as well, and Sue. I hope I get to play golf with your wife Sue again. But enough of the jibber jabber. Let's get on to the discussions. Are you ready, Martin? Because we've got a couple of interesting things to talk about. Maybe just quickly before we go there, Justin, you did mention the discretionary allowance. If you can just unpack that for us, how much do South Africans get in a year, and is it a calendar year? In other words, if we don't use that discretionary allowance by the end of December, does it fall away?
Yes, absolutely. As far as I understand, that's how it works. So you've got your R1 million, which you can take out. That is your discretion, and normally it's as simple as letting your bank know or getting a forex dealer to move money for you. And then there's the 10 million, which does involve, number one, having all your tax affairs up to date, and it does involve an application normally done by your bank or your forex dealer. So it's the 10 or the 1. But yes, if you don't use it, you lose it.
So you don't if you haven't used 2021's one, and you've got some of that R1 million available, Obvest, you're still at $5,000 entry level.
That's correct, yeah. And I think that, Alec, considering that people have had to cancel their overseas travel, I think there are a few people probably with some discretionary money that they would have spent on their travel.
There we go. 2 business class trips to London. Take the money from those flights and get yourself a slug of one of the medical properties that we're going to talk about now. So we're talking about 2 things today. A new project, number 37. Gee, you guys, wow. So that means it's your 37th project in the United States, medical building, Martin?
Quite correct. And so I think that we're going to consistently continue to acquire buildings like this, and what you're going to see today, together with a couple of other products that will give people the variety. And the most important thing is the variety. We've spoken about this before. Diversify. So even if you add your foreign investment allowance, which is a larger amount, I would still be recommending to anybody, just put a small amount consistently into each one of the deals and build yourself a mini portfolio, not only with us, but with others and various offshore investments.
And then the other, you've got the ODH. Just explain that briefly before we get there. That's more like a portfolio of portfolios.
So what happened was we were doing individually syndicated deals for the last couple of years, and it was driven by people that really just said, look, I don't have the time to actually look at each individual deal and understand it. I want to go into more of like a portfolio. And also for people that wanted lower risk, such as pensioners and retirees, who we have a lot of clients like that. They said, do you have a low risk product? And we said, yes. What we'll do is we'll put it together in a portfolio. You invest your $5,000 or $10,000 or $50,000 or $100,000, and we will then spread it across 8 or 9 or 10 buildings. And so you get the diversification already in it. And so if something goes wrong with one investment, it doesn't really affect your overall returns or dividends.
And the first 4 have closed, and you've started a new one today. So we've got lots to discuss, lots for you to share. I'm going to switch my camera off because the 2 of you are the stars of this show. Perhaps you can kick off with this slide and then just keep prodding me when we need to go to the next one, Martin, Justin.
Absolutely. So we'll give a quick overview, and I'll take you through the high level, and then Justin will take you to the actual deal today. And so for those that don't know who we are, Obvest, we're a global real estate company. We focus on acquiring healthcare medical assets in the United States only, and then we syndicate it around the world. So we've got investors from over 20 countries. The portfolio is around $400 million of acquisitions. As you can see on the screen, we target 7 to 9% cash dividends. That means that the buildings are income producing on day 1. they then generate these returns, and we pay them out quarterly. And then we also focus on total returns of 11 to 17%, which is the dividends you receive during the project plus your capital gain. And so if you add those two together, it's known as an IRR. And so that pretty much gives you a feel of who we are and what we do. On to the next slide. And so one of the reasons why we believe so strongly in healthcare is the very notion of healthcare professionals, doctors, dentists. They're well known in the community. They hang around a long time. They don't move. They sign long leases. They're profitable. And so we've been saying for many, many years prior to even COVID, if and when a correctional recession occurs, you want to be in healthcare assets. And so what we've seen over the COVID period is tremendous success in this asset class. And while it's great, it's also attracted a number of large players into the space, and certainly it's now recognized as one of the key asset classes in America that everybody's chasing. And so without further ado, I'm just going to hand over to Justin, who'll take you straight into one of our typical buildings that we would look to do.
Thanks, Martin. Yes. So, guys, Tampa Medical Arts Building, Medical 37. As Alex said earlier on, this is our 37th listing, but just bear in mind that some of these are more than one buildings. So, in fact, we're probably close to 40 buildings all in all. But this building is not actually available on the platform right now. So if you go to the OrbVest.com website, you won't find it. So we'll talk about how to get involved with this. We're hoping to have it live before the end of the week. But that's how fresh it is, Alex. So you guys are absolutely hearing about it first. So this is really hot with the press. It's a relatively small building, and if you go through the slides, it's only 22,000 square foot. So that's about 2,200 odd square meters. So a nice little small building. And just to give you an idea, location is everything in these buildings. We really, really go out of our way to try and find these buildings in the right locations. Remember that we are buying something that ultimately in 5 years' time we can sell at a profit. So it's not the greatest building if you look at the actual aesthetics, but if I can show you the location, you'll understand what I'm talking about. It's roughly 10 miles from the center of Tampa. As you know, Tampa in Florida is one of the really, really booming cities. There's very little vacancy in the city, but have a look at this slide here and you can get an idea of the location. It is right in the middle of the sort of healthcare node of Tampa. Right opposite it, and you will see, I can't put my mouse on it there. I don't know if you can see my mouse there, but there's the Advent Health Hospital in Tampa. And that is almost, an entire block. You can see the size of that. Oops, I think you moved off that. And the building that we bought is the little red box there, subject property, which is directly opposite the driveway of this massive 500 bed hospital that has just invested 250 million in refurbishment and expansion. So it's in the center of a healthcare zone, and this is what makes it such an absolute plum. So yeah, move on there, Alec. I think we can cover that.
Sorry about that. I was trying to get my mouse in the right spot there, but I'm just looking at this picture. It's almost, is it on the opposite side of the car park then from this, from the Advent Health Hospital? In other words, you walk across the car park and you're in the hospital, which is in exactly your sweet spot.
The entrances are directly opposite. If you turn right instead of left into the main entrance of the Advent Health Hospital, you would actually go into the building. And bear in mind, there are a lot of professionals that can't operate out of the hospital because they don't add any value to the hospital. And this is a beautiful picture here, Alec. This is actually standing on our driveway looking across the road. So it gives you some insight into how important this location is. So forget about the fact that it's not the most beautiful building, but the location is absolutely prime.
And so what I was going to also just add to that is that one of our favorite types of buildings to acquire is something that's on a hospital known as a campus, where you are right next to the hospital or opposite the hospital. Why? Because if you think about when you go for x-rays and that, often when you go to a hospital, even in South Africa, they will refer you to someone down the road. And so a lot of flow comes from the patients in the hospital outside, because number one, it's just more efficient, and also they want to get the traffic out of the hospital into more of a medical office building where you've got multi-tenants that do various kinds of disciplines.
Often the guys in property talk about location, location, location. I guess when you're talking about medical properties, given that you need to be close to facilities or where the operations are going to be done, etc., this is an even more important issue.
I think the most important thing to remember is that if a tenant does move out, and they do, the doctors get old, they retire, technology changes, etc., you want to make sure that there's a queue of tenants waiting for that space. Whereas if you're in a remote area, you might have a medical building, but the doctor moves out and you end up having to let it to an office tenant, which reduces the value of the building. So that's the importance of location on medical buildings.
Brilliant. Just to remind you, those members of the BizNews community who are attending this webinar live, you will see a little question mark on your control panel. Click on the question mark and type in your question, and we'll ask Justin and Martin to field those questions as we go along. So very simple. Click on the question mark, just type in your question, and as I said before, I will make sure that I don't use your surname. Okay, Justin.
Great. Let's move on through the slides. I need to show you a couple of the tenants that are in the building. I think this is very important, and certainly if you look at our history, the original sort of really high net worth guys that used to sort of syndicate with us, they really looked at and did a deep dive into who these tenants are and what the chances are of them staying. I think the important thing is this is a 5.1 WALT, which is average lease term, which means that if we hold the building for 5 years, the average lease is over 5 years. So that's the situation. There are a few that we have targeted. You'll see that Lucy Love, MD, been in the building forever. We believe that she will renew, and we'll certainly establish that during the tenant interviews, but we will try and extend that lease immediately because that is a rollover. And then vacancy. When we acquire one of these buildings, any space that's vacant is effectively value add, because if we do manage to fill the space, then immediately you get more income, and the way that a commercial building is valued is its income times cap rate, and that effectively establishes what the value of the building is. So we do have a vacancy there, and interestingly, it's on the 3rd floor. This is a 3-story building, which currently is not accessible because the lift is not taking you to the 3rd floor. As part of the deal acquisition terms, that lift is being refurbished and should be ready by December, which I guess is now, and that will open up the 3rd floor to another medical practitioner. So we are very confident we can get that small vacant space down the bottom, 260 square meters, tenanted, which is a very nice little boost and value add to the building. Let's keep it moving there.
2,600, is it? Not 260.
It's 2,600 square feet, cool. So that'll be 260 square meters.
Ah, okay. Well, you see, that just shows. Don't interrupt if you don't know what you're talking about. Apologies. Yeah, so very strong tenants is all I wanted to say. You can see the one tenant that's just signed as a NASDAQ company. So this is very important, and I know that we've got some newcomers on the webinar tonight that might not understand what all these numbers are about. I really want to just bring your attention to the fact that all the costs that we can ascertain are built into the project. So we acquire the building for $6.2 million. We allow for all the expenses over the next 5 years, including if a tenant leaves and we have to replace the tenant and pay a broker commission, etc. So at the very worst case, we believe this building will cost us $7.1 million all in. We borrow a certain proportion of it, and you see that LTV there. I don't think you can see my mouse, so I can't put. Can you see my? No, you obviously can't. Loan to value. That means we borrow 60% of the value of the building, which is very important. Remember that the cost of money in America is very cheap, and I'm going to round it down to about 3 to 3.5%, whereas we want returns much higher than that. So you want to leverage debt in the US. The other thing that's important is the debt coverage ratio, that thing called DCR there, and that effectively is the amount of cash flow that can service the bond. So you can service the bond 2.78 times on the free cash.
Then you will see that that's a very small building, so it's only $2.7 million that we're raising. So we expect to have that wrapped up sort of by Christmas. And the project parameters, that's also important to understand. Hurdle rate, what that means is that you as an investor get a preferential rate of 7%. In other words, you get the 7% before we get anything. And only after that do we start to earn our asset management fee. There's a small asset management fee that is built in, by the way, but it's about 0.03%. We'd like to get that up, but it is, predominantly our model is built around a success fee. So hurdle rate 7%. So you're going to get 7% on this. I'll show you a little bit more on that later. And then ultimately, if there is any above hurdle or any profit or capital gain at the end, which is what we're most focused on, then you get 70% of that, we get 15, and we have a co-sponsor on this particular building who we share that, we give 15 as well. So it's basically a 70-30 split in favor of the investor. If you move to the next slide there, Alec. Yeah, so, just, to give an example, if you were invested at $10,000, every year you would get $730 odd return as a dividend paid offshore into your Seychelles wallet. Ultimately, after the 5-year period, we would sell the building. There would be a capital gain. We would take that profit, we'd split it according to that previous slide, and you would end up with a 12 to 13% IRR. As Martin said early on, that equates roughly to your annual return. So you're getting a kind of a double figure annual return in US dollars that remains offshore. So I think that's really what it's about. International investor, by the way, is investors that go via our offshore structure. And if you just happen to be investing via the US, then you would get a slightly different return, but that is obviously pre-tax. So don't worry about the top bit, worry about the international investor side. So 11 to 12% net of taxes in the Seychelles, which of course is a tax-free environment. But that's that's that building. So very nice, simple, clean, nice spread of tenants, fantastic location, and as I say, that is open for the very, very first time, and only really exposed to the market today on this webinar. Let's roll,
Justin.
Alec.
Yeah, Florida. Have you got a project in Florida already?
Yes, we've done a few in Florida. We really like the state of Florida. It's a very fast-growing state. There are a lot of people moving to Florida at the moment. Martin, being there in the US and having visited all these buildings in Florida, will be able to tell you it's going crazy. You have really phenomenal growth in some of these little MSAs that we've invested in, and especially Tampa is growing very fast. Martin, do you want to add anything there?
Absolutely. So we've got, for example, Jacksonville. People don't realize the staggering growth that Jacksonville has gone through in the last couple of years. I mean, just property alone, with so many people flowing in, people are buying places for $200,000 and then now worth $600,000, and that's real growth. Not up and down like a bubble. We've also got in Orlando, where I went down and was instrumental in acquiring 2 buildings there opposite the hospital there, which was amazing. In Tampa in particular, we've had our eye on for a long time, and it's just very difficult to get these off-market deals. And so while this deal is very small for us, it's a great small little deal that I would buy all day long. The challenge is to find these kind of assets. So when they come up, you need to really move very quickly and acquire them. So I think Justin summed it up. Where you can go into a multi-tenanted building in a great location and earn double digits in dollars. Go back to the whole rand dollar discussion. It doesn't make a difference, because after 1 year, it's effectively like having moved your money instead of at 16 at 14.40, because you would have made essentially 10% in dollars.
And maybe before we go on to the next opportunity, the whole idea of Obvest and the way that you're inviting people to come and participate with you. I recall having this conversation with you in the past where your ambition was to become $1 billion company and a listing on NASDAQ. Is that still on the horizon?
Well, I'll say that our ambition is 100% to get the portfolio to $1 billion. Whether we actually then complete a listing on NASDAQ or not is up to the shareholders to decide. You know, there's a lot of costs that come along with it, and also a lot of regulation in the US. But in terms of just growing our portfolio consistently, what we've done, and you hit the nail on the head, is we've made investing for people internationally easy into the United States. So the structure is very simple. People go on, they speak to Justin and the team. We've got a whole team that believes in old school, holding you by the hand, you know, assisting you, helping fill out the documents, and getting the money seamlessly in, and then getting it seamlessly back to you. And that's really one of the key niches that we fill. You know, just making offshore investing super simple. And as long as the demand continues to flow in from not only South Africa, around the world, I think that you can see that it's very easy for us to fill up these kind of assets and acquire more and more.
The important part about that is that you are still hunting all the time, because with that ambition of getting to $1 billion, you're still looking for properties. It's not like, well, you got 37 projects, now let's just ease back and you know, smell the roses. That's not what you moved to New York for, Martin. There's ambition that still burns very strongly.
Well, there's a very strong team of 5 of us who have all got proud reputations in South Africa and big ambitions, as you said. We are still continuing to hunt. The challenge, though, I must tell you, is that I went to the BOMA conference, which was the medical conference, exactly 3 weeks ago in Dallas. And it was staggering the amount of large players all there who have suddenly arrived on the scene and said, oh, we're in healthcare. We all want to acquire healthcare now because that's the new flavor of the month. You know, whereas we've been doing it for many, many years. And so it is certainly becoming more competitive. And that's why more than ever, you know, being able to find off-market deals as opposed to trying to bid online is the key to it. Obviously, if you assemble a large portfolio, you become very attractive as a target to be acquired, or alternatively to sell the whole portfolio at a profit to these large REITs in America who are just awash in cash.
But the point as well, and maybe Justin, you should mention this, because when you started private property, it was a similar thing. You went online, you made it easy for people to invest through the internet in property. With Obvest, it's almost a similar playbook.
Yeah, like it is. I must say it's turned out to be much more complicated than I thought. I thought we could make it a complete platform play, but you know, with all the international compliance and the regulations, it's a lot more complicated than we would like it to be. But no, the ultimate goal would be to make it completely seamless, that you can go online and do it while you are online. But I think we're a little way off that.
But Justin, I just want to jump in and say for everyone listening, you know, it's ultimately, you know, complicated the first time you set things up. So when you set up your account and you go online, you fill in your documents, because there's AML and KYC. There afterwards, it is completely seamless. You know, you put the money in your wallet, you pick a project and you invest online. But for Justin and I, we both are gunning for the silver bullet, which is you go online with no human intervention and you just put in your credit card details and off you go, like what happens in the US. But obviously cross-border still remains a little bit more complicated. And that's the reason why we have the team available to assist you.
I've got a couple of questions before we go.
Yeah, watch this space, because you know, I think a lot is changing in the world, and we've certainly seen the advent of cryptocurrency and all that. And I think that the regulators are having to look at things very, very differently. So you know, ultimately, you know, we do have our eye on the ball. Don't worry.
There are a couple of questions before we go onto the next opportunity. Tace asks, he says, is this only for the super rich, or can you invest 100,000 Rand?
No, absolutely, Tace. You know, I think that initially it was for high net worth individuals, but we've made it accessible. And the reason is because people like to taste it. They like to get to feel the product and see the dividends in their account. So we make it available from $5,000, which is about 75,000 Rand. So yes, we can do 100,000 Rand.
And Mike asks, for American non-residents, e.g. South Africans, what are the tax impacts with regard to federal estate tax, or CITES, and other USA taxes?
So this is where we've made it super simple. The idea is we consolidate all the invested in a listed environment in the Seychelles. We use an exchange. So effectively, you're buying a security. That company then owns the underlying assets. So all of the taxes are paid. Everything is resolved in the US, and then the dividends flow from the US back to the Seychelles. So as far as the US is concerned, you are just part of a company and you are completely anonymous from the US tax regulatory environment.
So you're not going to be hit for CITES or for US estate duty?
You have no investment in the US. You have a security which owns a company, you own a part of a company in the Seychelles, and that Seychelles listed company then invests with one check into an Inc. level company in the US, which ultimately owns the SPV, which owns the property.
And I must just also add to that and to say that, you know, with companies like ourselves having managed to implement these kind of processes and systems, the amount of money flowing in from China, from Israel, from Brazil and other countries is astonishing into the US, into the various other asset classes, not only real estate, but, you know, private equity, etc. So it is a widely accepted method of helping people really invest into the United States, which is then powering the economy.
Excellent. Okay. Just to remind you that you can press a little question mark and type in your question if you have one for Justin and Martin. ODH5, the fifth version of the opportunity. Over to you,
I'm going to give that. I'm going to give that back to Martin, but I want to explain a little bit more, give a bit more detail to this, Alec. So if you think about our origins, originally it's high net worth guys getting together and buying these buildings. It's not so easy to buy a building on your own. You know, that's what we're around for. So then, of course, we have changed to smaller investors, and ultimately we started to become approached by the financial advisors. Financial advisors are now taking a guy's investment out of a non-performing asset, his pension fund or whatever, and putting the whole lot into one building. And when we started to see it happening about 2 years ago, I think you know, we got into a little bit of a panic. We don't want to have South African pensioners dependent on single buildings. Things can go wrong. So we decided to consolidate some assets together to create more of a spread. And that is the origins of ODH. And initially we tried it with ODH1. It was very small, $2.5 million. And the thing sold out literally in a week. Very, very popular, especially amongst people that depend on those, you know, those. This one is $5 million. And the thing is, Alec, as you can probably understand, we can't just launch lots of these things because each individual ODH owns a portion of each of our buildings that has either happened already or is that it's going to happen in the next few months. So we have to actually bridge that in the existing buildings. And we actually ran out. When we did our first ODH 1, 2, 3, and 4, we had nothing left to, you know, to apportion to that ODH 5. So we had to leave it for a couple of months in order to be able to build up a little bit of a head of building. So you'll see when we get into this presentation, you'll see that we've already got, and I think I worked out it's about 14 buildings there already, Martin, even though it's spread across 10 investments. Remember, some investments are more than 2 buildings. But anyway, you love this thing, Martin, you talk about it.
Alec, I think that Justin hit the nail on the head. I really do love it. It's one of my favorite products. In fact, you know, my advice to my own family is ODH5 is probably the best investment I think I've ever seen us put on the platform, just because it's just so diversified. If we go to the next slide, you'll see exactly what I mean. And so for a very small amount of money, what I also want to just mention to everyone is that, you know, you take your $5,000, I think it was Tace who mentioned it, you know, if you wanted to go and spread your money across 6 buildings, you would need $30,000. Here for $5,000, you're actually already across multiple investments. So it's accessible to everyone in South Africa. It's obviously spread across all our states that we play in, which is, for example, in Florida, New Jersey, Atlanta, Georgia, Texas, Arizona, and others, and Cincinnati, Ohio. And so you get a nice mix of different tenants, different states, different buildings. And it's $5 million, as Justin mentioned. And our typical hold time on properties is 5 years. We do give ourselves an extra 6 months at the end of 5 years in case we're still wrapping up a deal or still selling. But I think there is also the scenario that some of these buildings will be sold sooner if we get an amazing price on some of them. And so that flows up through into ODH. If we go on to the next slide, these are the kind of buildings now. I just want to make it very clear to everyone. These are buildings that Obvest already owns. We bought them. I've been to every single one of these buildings in the past year. So from Medical 29 to Medical 30, one of our best buildings in Arizona, into Medical 31, which is in Princeton, and then so on and so on. If you keep going, Alec. What you'll also notice is that the IRRs, meaning the total returns we expect on these buildings on the right-hand side, is significantly more than 10%. However, one of the things that we try and achieve in Obvest is under promise and over deliver. So what you'll see when we get to the final results is a more conservative approach, but really what you'll see is that we then take your money and we invest, as you see on the slide here, into each of our buildings, a small piece. There are also a number of rules. Remember, we are listed on the Seychelles Stock Exchange. This has to be approved, and this has to go before their committee. So we can't, for example, take more than 16% of a particular building or have more than 16% of the equity in it. There's a whole lot of rules to make sure that it remains diversified. You will also see over here that the after-tax IRR is anywhere from 10 to 11 to, in some cases, 12, 13%. And so we certainly are very bullish on the performance of this particular ODH5. If we go on to the next slide.
Yeah, if you just look, sorry, Martin, I just wanted to cover those buildings that we're actually seeing there, the ones in gray, and certainly one or two that are at the bottom of the list, are already invested in. So there is already that investment made on behalf of ODH5. So you know immediately where your money is going to go.
And so a large chunk of it is already producing dividends and has been for the last couple of months already. So what we did when we acquired it, as Justin said, is we said, listen, we've already got ODH 1, 2, 3, and 4. When we close, we will bridge another, call it $200,000, and put it aside for ODH 5. And so that's what we did. And when we built up enough deals, then we were ready to launch ODH 5. You can see over here the typical scenario of the minimum number of projects is going to be 13, which is a nice spread. In fact, it's more aggressive than we even thought possible. We thought probably 10, but given the fact we already on potentially looking at 13 is fantastic. You can see that our AUM fees, which is the management fees we charge for this, is 0.3%. It's really low. It's well priced. And if you had to invest $10,000, this is your indicative returns that you would receive over the 5 years. And the one I want to highlight is at the very bottom, it says 10.3% total returns after tax. It means your gross returns is probably sitting in the mid 11s. But again, I think where we are at this stage right now is that I'm bullish to say that we expect this product to perform really well, given that some of these buildings that we've acquired have already shown significant growth in their value, because everything has become more expensive in the United States in terms of the medical niche.
It looks like it's a disclaimer. Justin, do you want to take us through that?
Yes, just very important. We are a registered financial service provider in South Africa, and we comply with lots of other laws from around the world. So just humor me while I make sure that people understand. Past performance does not necessarily guarantee future performance. I think it's very important to understand that these workshops are for information purposes only, and we don't recommend that you do any buying and selling of our securities unless you've taken some advice or you are comfortable with making the decision yourself based on the information that you've received. But yeah, just to let you know, we do have, if you are based in South Africa, certainly we have financial advisors that are employed by us that can actually assist you only with this product, obviously. But they are on call to assist you at any point if you would like any further advice. And I think that Stuart, Alec, did actually put a link, if you don't mind me having a little commercial punt here, in the chat box there. If you'd like to click on that link, I think it takes you through to just a little information page. And if you just fill in your information there, we'll get someone to get back to you.
Brilliant.
So,
well,
something we haven't spoken about is the actual take-up of the equity in these deals. So Justin has the unenviable job of having to carve up these deals around the world. So what happens is that in each of the countries, he'll allocate, for example, country A, you can have $300,000, you can have $500,000. And so it becomes quite competitive. And so that's the reason why often when you see these deals, they get snapped up so quickly, because not only do we have the countries, but then we have existing clients who came to us and said, I've got $100,000, and they started to invest their first 20. And now they've got in the next 2 buildings. So there's this pipeline of equity waiting to be deployed quickly. So what we have found, as Justin mentioned, in November so far is a very buoyant month, given as we move towards year end and people want to get their, investment allowance, their discretionary allowance in for the 2021 year.
So let me just understand, with ODH5, which is the diversified portfolio, the one we're looking at on the screen now, that is available for investment today, even though you might, the cash might not immediately be invested into a property. Let's just say you got somebody who came along with $5 million. Presumably you wouldn't be able to satisfy all of that if you're only looking for a smaller amount.
Yeah, correct. Well, first of all, if they came with $5 million, we wouldn't be able to accommodate them anyway, because the maximum we're allowed to raise on this is $5 million. So, and it's already, $1 or $2 million has gone. So, so probably about $3 million left, Alec. But yes, I think that what we anticipate over the next 2 months or going into Christmas is that, this will be taken up, as I say, by probably around 40 odd investors that will take up this product. And another one, as I say, it's a much smaller raise. So I think there's only about 2 million available at this point, even pre-launch. As Martin said, some of it's been pre-allocated. So that should be wrapped up by Christmas.
Well, you have a lot of our community members already or members of the BizNews tribe who already are investors. And I've got a few questions to come up here. But Martin, are you making a point?
I was just going to say that if there is any excess cash, what we do as part of the ODH portfolio product is that we use some of that in the bridging capacity. It generates a 10% return. And so that's the reason why you're always able to put the cash to work straight away and generate returns for the ODH investors.
Good. Well, I'll put my camera on again so you can see that I am here, not just a cardboard cutout, and we can get into some of those questions if you guys are happy. Shaman asks, what's the difference between ODH and triple net that you also have as a structure?
That's a great question. So triple net is a product where we have single tenanted buildings. They're not multi-tenanted buildings. So for example, you would get a Fresenius, a Davida, any one of the well-known brands in America, like a dental practice, a standalone dental practice. It's got generally a 10 to 20-year lease, exceedingly long leases. And so what we did was we created, similar to ODH, but what we decided to do is put 10 of those small little buildings together under a triple net. And the reason why it's called triple net is because those single tenants pay for pretty much everything in the building. So you acquire the building, and literally, other than maybe some roof maintenance and maybe the parking lot, they will pay for everything else. And hence, it's known as a triple net in the United States. And so for the same $5,000, you put it in, and it's spread over 10 smaller triple net tenants or buildings.
Yeah, I get that question a lot at the moment, Martin. So returns are pretty much the same. I think it's a matter of choice. Bear in mind, triple net, you have maybe a little bit less risk in the quality of the tenant, because that has to comply with some rules, as Martin said. But you only have maybe 8 tenants, whereas on ODH5 you will probably have about 80 tenants by the time that is fully subscribed. So you have a huge spread of tenants over a very, very broad market segment, and I think it's about spread. If you really want spread, you go the ODH way. If you like the idea of owning a bit of a CVS, in your favorite town, then maybe you might prefer the triple net. But returns wise, much of a muchness. Risk wise, pretty similar. It's a preference thing.
Here's a question from Mr. B. I'm going to call you Mr. B because if I told your first name, it would give it away. He says, hi, Martin, Justin, Alec. Thanks again for the opportunity on Medical 37. Did my first investment with you guys at OrbVest after the presentation you did with Alec last year, 2020, and I've invested on Medical 29, ODH 4, and Medical 33. Love the divvies every quarter, all reinvested, and great returns. Thanks. With regards to Medical 37, 71.3% ROI percentage return. Is that pre-tax? That's pretty good. Aren't you having issues of tenants in your buildings?
So I think I can take that in terms of tenants in the buildings. So tenants in the buildings, we have in some of our buildings lease up scenarios where in the United States it takes long to get them in, and regulation is impossible over here. At least the one thing is United States might work, but it works very slowly when it comes to getting people into buildings. Regarding the tenants that are in the buildings, they really are very stable and they stick around, as we know, and we've seen it so far. So what I would say to Mr. B is that the tenants that are currently in the building, we do tenant interviews before we acquire any building. We physically speak to them, their experience, how long they've been there, what are their thoughts of renewing and staying. And so it really was a very positive experience on this building. The amount of space allocated as vacant is very, very small. And so, you know, if you get it ready, and this is what a lot of landlords don't do, they don't get the space ready. When a doctor comes along, you know, he can't visualize it. He wants it to be nice looking, that you can say, listen, here it is, it's ready to go in 60, 90 days you can be in, subject to your license. And so that's what we also do when we acquire these buildings.
Indeed, Mr. B, thanks very much for those kind words in the beginning. But you know, this is typically what happens is these, especially the doctor-owned buildings, you know, the empty space becomes the junkyard that you throw your empty copiers and broken machines and things. And you know, people just haven't got a vision. But I think what's most important in this medical 37 is that the space that's available is on the 3rd floor. It is in fact the entire 3rd floor. And right now the elevator doesn't work to the 3rd floor. So the elevator is being replaced. It's an old elevator. It's being put, a new elevator is being put in there, which will then go up to the 3rd floor. So we're very confident, and certainly the brokers are very confident that in that location we'll pull that thing very, very quickly. Of course, we haven't budgeted for that, so if it happens, you know, quickly, then you know, it's a bonus.
Alec, I just want to jump in here and mention to you that, you know, I traveled to a lot of these buildings, and it's quite astounding, you know, that you would expect in America that people own these buildings, which on the face of it, $7 million is 100 and something million rand. But often it's medical practitioners who owned it 20 years ago, and they really just don't pay much attention to these buildings. I mean, I'll often go there and the sign is like half falling off, and I think, like, for a building that size and for that amount of money, just spend a couple of $1,000s and make it look reasonably nice. And so that's the opportunity for players like ourselves to acquire these buildings. You spend a little bit of money, you treat them with tender loving care, and then they do come to life.
As they have. Just to remind you, we are coming to the end of our program for today, of our webinar for today. Time really has flown, but if you would like to have your question posed, please click on the question mark and type it in as John did. And here's a very interesting question. There's another one here, a comment, I think, from Gerardus. Gerardus, I hope you've got sound. He said there was no sound, but as you're the only person who's not getting sound, it could be on your, in fact, it probably is on your end. But John's question is a goodie. Rising interest rates, are they going to affect your leverage?
So I think rising interest rates is something that we're following all the time. Bearing in mind on our buildings, what we do is we lock in the rate. So we prefer to lock in the rate. You know, if it's 3.25, I'd rather take a 3.5 and put in what's known as a swap to cap the rate exposure from an interest rate on the debt. The good thing is that as inflation kicks in and as we renew leases, what happens is your income starts to rise more than what we thought, number one. And so what that does is when you sell your building, it's based on your income. The higher your income, your building's worth more. The second thing is that what's happening is that inflation in the US and interest rates is potentially pushing up the construction of new buildings. And so what there is huge acknowledgement about is the fact that the new buildings are costing so much more at the moment in the US, given also supply chain shortages. And what that means is they're having to charge more rent. And what that means for existing buildings that we buy is they become more valuable. So we're quite bullish at the moment on what's actually happening. In fact, it's playing into our favor, provided there are no major disruptions that we cannot foresee going forward.
That's interesting. The other question, I guess it would be the last one today, is what's next from OrbVest?
So what's next from OrbVest is it's a good question as we are on the 1st of December, Alec. No one's posed that to me yet. I set out a goal at the beginning of the year to acquire a minimum of 10 buildings, and we've done that. I think that as we go into next year, there's going to be a move to try and acquire some larger assets. When I say larger assets, $50 million on a building, single building, which is sizable. And I think you're going to find a lot more variety on our platform as our relationships and network continues to grow in the US. So I would like to be able to say to people, I'd like to bring a deal to the platform every single month. So every single month you can put a little bit of money in and really build yourself a nice little portfolio in the US. And I think you're going to see a lot more of that as we enter Q1. And Q1 2022, I think is going to be very buoyant for Obvest.
50 million, that sounds really big. What's your biggest building, your biggest single project to this point?
So we do have buildings prior to COVID that were at $50 and $60 million. But I think the difference is in those days we did them with more of developers who transitioned buildings. I think as we've grown as Obvest into being the sole general partner, we will do this on our own. And I think that we just need to make sure that with our reputation, we can continue to deliver to the community in the US. Because the one thing they want is they want people who are going to commit to a transaction and don't let them down or retrade. Retrade in America is very popular, Alex. I'll buy your building, I'll wait until 2 weeks before, and then I'll renegotiate you. And it's actually quite common.
Really?
And in fact, all of a sudden they come to ourselves as Obvest, and if we like your numbers and we men of our word, we commit to the deal, we're not going to retrade you. And I think that's the reason why a lot of people are knowing the Obvest brand now, and they come to us.
That doesn't sound very ethical, that you agree a deal and you get 2 weeks before, you then go and renegotiate.
Well, I can't agree with everything in the US, but I can say that hopefully, we do things slightly differently as South Africans. And I think really, we do stick to the mantra of our word is our bond, and, we do follow through on what we say. And I think that's been part of the Obvest success story to date.
Well, maybe you should head off to Omaha and go and get a medical building there. I'm sure that Warren Buffett will tell you that there his word is his bond and a handshake's a deal. You might find a similar kind of approach there. Justin, before we go, I'm just thinking about what Martin said before. If you are looking to invest next year, but you haven't got $5,000 a month, is there a facility that you can put a few thousand rands aside, or should you be doing that yourself? When you want to participate in OrbVest looking at 2022 and those 10 buildings that Martin's going to have to go and find somewhere?
Alec, I think that might be part of the conversation about what we might be up to next year. And I think I'm kind of hoping that we'll do it with one of your partners. But right now we don't do an FDI type investment, so you have to accumulate the money and move it yourself offshore. So, unfortunately, we don't have a facility right now that you can collect rands and then transfer, let them accumulate and then move them in one shot. So, not yet, but I think watch the space.
Yeah, it is a point that you have at this point in time made it $5,000 you can buy into a medical building in the US, and that's a huge jump from where one might have been in the past. Final word from you, Martin, before we close off tonight.
So it's pertinent. You just reminded me that it's probably the last webinar we might do for the year, and I just wanted to say a huge thank you to you and your entire team and the BizNews community for supporting us this year. It's been great to see us go through all these deals and just see the growth. And I just wanted to say that we really appreciate everybody putting their money into OrbVest and trusting us with their wealth. And I just wish everyone a peaceful year end and see you back in 2022.
Justin, your last word?
I haven't got much to add to that. Obviously, I concur 100% with what Martin said. You've been fantastic partners, and your community has been very, very loyal to us. So thank you for those of you who are joining us today. But I'm going to give you one more thing, Alec, and that is we haven't done this before in our history, and we've tried to stay away from it. But based on your last question, we are going to, between now and December, we are going to drop that $5,000 only on BizNews for BizNews listeners to $1,000. And
whoa,
really, because we want to get people to taste. We want to get people to taste it. So if you're considering it, take $1,000. You can virtually do it on your credit card, and make an investment and taste it, enjoy the dividend, and see that this thing works for yourself. And so that's it. First on BizNews, Medical 37. First on BizNews, $1,000 just till December. We'll take any $1,000 investors who want to come along.
ODH 5 is also $1,000.
We'll do it on both.
Brilliant. Thank you. That is a phenomenal concession to our community. Thank you, Justin and Martin. And really, it's been our pleasure to be your partner. As you know, crumbs, it feels like a different era, Martin, when we met here in Johannesburg pre-COVID, when we could still see each other in a room and have a cup of coffee and shake hands at that point. And it has been a real privilege to be your partner, and long may it continue. I know that our community have benefited hugely from this relationship. Many people buying into Obvest early on, getting a fantastic dollar return now compared with the current rand rate. And when you have a look into the future, as someone who lives in, I think a good friend of mine said to me that the smartest bit of advice he was ever given was keep yourself in a warm country, but put your money into a cold one. And certainly right now, the US is a lot colder than it is here in South Africa. But I think the point there being that enjoy the lifestyle and the fantastic living that South Africa can give you, but be aware that there are risks that come with it as well. And investing into a first world environment. And now that you've made it, I mean, really, that's a great surprise, Justin. I will certainly let members of the BizNews community know that. And I hope it's not going to knock your admin team for 6, but once you've tasted it, I'm sure it'll be a good opportunity into the future. So once again, gents, lovely seeing you, and look forward to seeing you in person again. Justin, I'm sure you'll be at the conference in March.
Absolutely, absolutely.
Not for you this time, Martin, but we'll be back. Hopefully, you can come and tell us some more stories in September at the next conference. But certainly, look forward to seeing you then, and also to you, wonderful end of the year, and may 2022 bring you everything that you richly deserve. From me, Alec Hogg, and the BizNews community as a whole. Until the next time, cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.